I've been talking about this now for a couple weeks. We are in earnings season. We are at the end of earnings season, but you wouldn't think so with the fact that we have 1,000 companies reporting on one of the biggest weeks of earnings that we can see. So let's break down the biggest companies reporting this week, and of course, how I like to trade them on the backside of earnings. So, 1,000 companies are reporting. I'm just going to show you I think 10, 11, 12 of them that I'm following this week. So here's Tuesday. We got Super Microcomputer, that's SMCI. We have Rivian, RIVN, Snapchat. I call it Snapchat, but the company's official name is Snap. And so is its symbol, SNAP. And Upstart, which is UPST. That is on Tuesday. Wednesday, we're looking at Airbnb. I'm looking at, that's AppLovin, all right, Appian, AppLovin, DraftKings, DKNG, and Duolingo, which is DUOL. And then finally on Thursday, I'm looking at Celsius, that's CELH, Trade Desk, TDD, SoundHound, which is SOUN, and Pinterest, PINS. Now, why didn't I look at Monday? Well, why didn't I look at Friday? Because the bulk of earnings that happen in a week happen on Tuesdays, Wednesdays, and Thursdays. Okay? That's where I find most of my earnings opportunities. So, what did I look at here? 11 or 12? Going to just take another look here. So I got a dozen of them on here. I believe 11 of these have the data that I need to show you what it is that I look at and what I do. So many of these, when you go into earnings season, it's much easier for me to predict spikes in IV than it is to predict price, because spikes in IV happen almost like clockwork every 3 months. Now, there's a little give and take in there too, because sometimes earnings get reported earlier or later than what's on the schedule. But I'm looking for this particular pattern that I see here on the screen. So I'm going to grab what I think is the biggest ones. But before I do that, I have to show you some data. This is a lot of data here. So what I want to do is I want to take my red mouse and I want to walk you through everything that you see here. So when I look at data and I categorize data, when I'm looking at IV, I am looking at, obviously, I took those 11 of those 12 names I've got data on. And what I did was, yes, I've got the name here, and I've got the stock price, and I've got some areas I can go look at pictures on the stock. But I've also got the earnings dates, which are all happening this week. All right. I also have the most recent close. But over here to the right, this is the important stuff right here if you're an option trader. So what I'm looking at is I had this ranked by short-term volatility, meaning who has the highest volatility going into earnings. And so number one is Duolingo. Duolingo has a 69% IV. And so what that means is that as we look at it, yes, when you're looking at implied volatility, 69%, that's for the 7 to 30 day IV. That means that I'm looking at options that expire between 7 and 30 days. Now, I also have a category for the 30 to 60 day percentile. And I also have the category for the 60 to 90% IV. So if I'm trading options that are the 30-day options, I'm most interested in this area. If I'm looking at 30 to 60, I'm interested in this area, all right, the 30 to 60 IVs. If I'm looking at 60 to 90, I'm interested in this category. Notice here, because I ranked everything by 7 to 30, Duolingo is at the top. Duolingo is also at the top, and you got to look around here to make sure, of the 30-60. See, it's a 55.99, where everything else is much less. And then if you look at the 60 to 90 IV, this is really interesting. Duolingo jumps up to 76, which tells me that they've got another earnings report that's going to happen on the back end of this area here. So Duolingo hits all of the IVs when it comes to ranking by most expensive. Number 2 is Trade Desk. This is interesting here. Trade Desk hits number 1, it hits number 2, and it does hit number 3. So Trade Desk is clearly Short-term, intermediate, longer-term volatility, implied volatility, all at the top. But then you go on the AppLovin Corporation, and you see that Upstart, Airbnb, DraftKings, Pinterest. AppLovin was not number 3 on the 30-60. The rank shows Upstart. But then look at the 30 to 60. It is number 3. Look at the 60 to 90. It is number 3. So that's why I highlighted these areas to show you that even though I'm ranking by short-term options, I'm looking at those long-term options to see if there's something out there that might make some sense for us as we are looking down the road in terms of trading these. So, what do I think about all of these stocks? I don't. I'm not particularly bullish. I'm not particularly bearish. The only thing this chart shows me is that there is a consistency of a lot of traders out there overpaying for calls and overpaying for puts. So if I am looking at maybe grabbing 1 or 2 of these stocks at a discount, I can do that and get paid for that. And this is how. Take a look at Duolingo for a second. Here is the chart of the IV. Notice where it is coming into today. It's actually higher than the last 2 earnings reports. That's incredible. And it's not due to report here for a couple more days. Take a look at Trade Desk. Trade Desk is higher than the earnings that we saw in recent quarters, but last quarter's earnings have beat it. But it too does not report for a couple of days. So there's still a little more time for this IV to run even higher. Finally, AppLovin Corporation. AppLovin Corporation is at number 3, but notice it has not gotten yet up to the highs that we saw in past earnings. Although I have to say it again, AppLovin also doesn't report for a few days. So there you go. So we're seeing all of these reporting Wednesday to Thursday. So if you're looking at this on Wednesday, you still got time to look at these as potential opportunities. Potential opportunity. I don't want to go long the stock if I'm bullish. I don't want to go long a call if I'm bullish. I want to use the probabilities and bend them into my terms and my rules by shorting puts. All right? Shorting puts do have large risks. They could potentially have large rewards if you're assigned, but when you're inside the actual put option itself, the reward is fixed and the risk is more dramatic as the stock goes, if stock were to drop down to near zero. Why do I do these then? Because I'm being paid to obligate myself at any price I like. You get paid a premium for that, and cash secured puts are one of the best ways to create wealth and income that are out there that I know if you favor buying something or getting a chance to buy something on the cheap. Let me talk about how that works. So Duolingo coming into the day was at $339. Okay, this is a snapshot of Robinhood. You can find this on any of your broker's websites that have options, and you'll see that this is the September 19th. All right, September 19th is the 250 put. Duolingo is trading at $339 as of this particular snapshot. The 250 puts, at the time, you could get $6.25 for those. So for one contract, which is good for 100 shares of stock, you're getting paid $625 to potentially, I call it placing a limit order to buy Duolingo at $250, which is what? Almost $90 below today's share price. That's what I like about this strategy. I get paid whether or not I end up getting that stock at a below market price. All right, so in summary, my earning stocks do's and don'ts. Number 1, buying options when you're coming up upon an earnings report, not an option, especially with the stocks that I showed you today, because they are grossly overpriced when it comes to calls and puts. If something fits your bull or bear signals, consider selling option premium. That's the probable trade. That's the high probability trade and the concept that I use. Next, you could choose to sell naked options, but that might be too expensive for you. If so, consider credit spreads. And what you're doing with credit spreads is when you sell a put, you are then buying a lower strike put for insurance, or if you're selling a call option, if you're bearish, then you're gonna buy a higher strike call for insurance. What you're doing is you're putting that trade on for a credit. It also has higher probability, but with the credit spread, you lower your margin cost and you lower your risk. And then finally, and I said it once, but I'll say it again, on the bullish side, I look to sell puts or put spreads. And when it comes to bearish stocks coming into earnings, when you have high volatility, I will look to sell calls, or in the case of spreads, call spreads. That's how you do it on earnings season, folks. That's the way I do it.